Stock. A financial instrument representing ownership in a company, with each unit called a share. Shareholders own a proportionate part of the company's assets and profits. For example, owning 50% of a company's stock means owning half the company. Stocks are a primary way companies raise capital, and their value fluctuates based on company performance and market demand. Stocks are bought and sold on stock exchanges, where their prices are determined through trading activities among investors. Stock exchange. A marketplace where investors buy and sell stocks. Exchanges facilitate the trading of publicly listed shares, ensuring transparency, fairness, and liquidity. Prominent examples include the New York Stock Exchange, NYSE, and NASDAQ. They provide a regulated environment where prices are determined by supply and demand. Stock exchanges also play a crucial role in the economy by helping companies raise capital and allowing investors to gain ownership in businesses through stock purchases. Bull market and bear market. A bull market refers to a period when stock prices are consistently rising, driven by investor optimism and economic growth. In contrast, a bear market signifies a prolonged drop in stock prices, reflecting pessimism and often an economic downturn. These terms are derived from the animal's attack styles. Bulls thrust upward with their horns, while bears swipe downward with their paws. Understanding these trends helps investors make informed decisions about their trading strategies. Liquidity refers to how easily an asset, such as a stock, can be bought or sold in the market without significantly affecting its price. Stocks with high liquidity have frequent trading activity, ensuring quick transactions. Liquidity is essential for investors who may need to convert their holdings into cash swiftly. It increases with trading volume, as more participants actively buying and selling create smoother market conditions and tighter bid-ask spreads. Dividends. A portion of a company's earnings distributed to shareholders, typically as cash or additional shares. Companies with stable profits often pay regular dividends, providing investors with a steady income stream. However, not all companies offer dividends. Some reinvest profits for growth. Dividend-paying stocks are particularly attractive to long-term investors seeking consistent returns alongside potential stock price appreciation, often seen in well-established firms known as blue-chip companies. Capital refers to any resource that adds value to its owner, though it typically denotes financial assets like cash or investments. Businesses use capital to fund operations, expand, or acquire assets like machinery and patents. In personal finance, capital may include savings or investments. Distinguishing between physical, financial, and human capital helps investors assess resources and growth potential, making it a cornerstone of investment analysis and business valuation. Assets. Economic resources owned or controlled by an individual or company that provide future benefits, typically measured in financial terms. Common examples include cash, real estate, equipment, and intellectual property. Assets are categorized as tangible or intangible and can also be classified as current, short-term, or fixed, long-term. Investors evaluate a company's assets to gauge its financial health and operational capacity, with strong assets often signaling stability and growth opportunities. Volatility measures how much and how quickly a stock's price fluctuates over time. High volatility indicates rapid price swings, often driven by news, market sentiment, or economic changes. While volatile stocks can offer significant profit opportunities, they also come with higher risk. Low volatility, on the other hand, suggests stable price movements, appealing to conservative investors. Understanding volatility helps investors align their risk tolerance with their investment strategies, ensuring balanced decision-making. Long and short positions represent opposing investment strategies. Going long means buying stocks with the expectation of a price increase, allowing profits by selling at a higher price. Shorting involves borrowing stocks to sell them immediately, aiming to buy back later at a lower price for profit. Long positions reflect optimism in a company, while shorting bets on a price decline. Both strategies carry risks, particularly shorting, which has unlimited loss potential if stock prices rise unexpectedly. Day and swing trading. These strategies differ in timing and risk. Day trading involves buying and selling stocks within a single trading day, seeking short-term profits through rapid price movements. Swing trading spans a few days to several months, aiming to capture larger price trends. Day trading requires quick decision-making and high risk tolerance, while swing trading offers a slower pace with less stress but still depends on market analysis for success. Price to earnings, P/E ratio. A widely used metric to evaluate a stock's valuation. It divides a company's stock price by its earnings per share, helping investors determine if the stock is overvalued or undervalued. A high P/E ratio suggests optimism about future growth, while a low P/E may indicate undervaluation. However, P/E ratios should be used cautiously as they rely on past earnings, which may not predict future performance. They are most effective when compared across similar companies or industries.
Index funds.
A type of mutual fund or exchange-traded fund, ETF, designed to replicate the performance of a specific market index, such as the S&P 500. These funds offer broad market exposure, low costs, and diversification, making them a popular choice for long-term investors. Unlike actively managed funds, index funds follow a passive strategy, aiming to match the index's returns rather than outperform it. They are ideal for minimizing risk while benefiting from general market growth. ETFs, exchange-traded funds. Investment funds are traded on stock exchanges, combining the features of stocks and mutual funds. ETFs can track indexes, commodities, or sectors and trade like individual stocks throughout the day. They provide diversification, liquidity, and lower costs compared to traditional mutual funds. ETFs are suitable for passive investors aiming to match market returns or active traders looking for quick trades in specific market segments. They can be either passively or actively managed depending on their strategy. Technical analysis. A trading approach that analyzes historical price charts, volume, and other market data to identify patterns and predict future price movements. This method relies on trends and statistical indicators, such as moving averages and relative strength indexes, RSI, rather than a company's financial fundamentals. It's widely used by short-term traders to time entry and exit points, though critics argue it overlooks underlying business factors and is not always reliable. Fundamental analysis focuses on evaluating a company's intrinsic value by analyzing its financial health, competitive position, management effectiveness, and industry conditions. Investors use this approach to determine whether a stock is undervalued or overvalued compared to its actual worth. Fundamental analysis involves reviewing financial statements, earnings reports, and market conditions, aiming to make informed long-term investment decisions. It contrasts with technical analysis, which prioritizes market trends over business fundamentals. Market bubbles and crashes. Bubbles occur when asset prices rise far beyond their intrinsic value due to excessive optimism. Eventually, prices become unsustainable, leading to dramatic crashes as the market corrects itself. Bubbles can devastate investors who enter late, while crashes cause widespread losses across sectors. Historical examples, such as the dot-com bubble, highlight the dangers of speculative investing.
Black swan events.
These are unpredictable, high-impact occurrences that significantly affect markets, such as financial crises or global pandemics. The term emphasizes their rarity and inability to foresee using standard risk analysis. Black swan events often trigger panic selling, market crashes, and economic instability. Investors can prepare by maintaining diversified portfolios, adopting hedging strategies, and ensuring liquidity to navigate unexpected downturns effectively.
Pump and dump schemes.
A form of investment fraud where individuals artificially inflate a stock's price through misleading statements, pump, and then sell off their holdings at a profit, dump, leaving other investors with devalued assets. These schemes often target penny stocks or less regulated markets, preying on inexperienced investors. Insider trading. The illegal act of trading stocks using non-public, confidential information, often obtained by company employees or executives. Insider trading gives individuals an unfair advantage and undermines market integrity. While difficult to detect, authorities impose strict penalties on offenders to maintain a level playing field for all investors. Staying informed and relying only on publicly available information ensures ethical and compliant investment practices. Volatility and panic selling. High volatility leads to rapid and unpredictable price swings, often driven by news or investor sentiment. This can provoke panic selling, where fear triggers widespread liquidation of assets, accelerating market declines. Panic selling can create buying opportunities for disciplined investors but also leads to significant losses for those acting on emotion.
Limit orders.
These orders specify the maximum price you are willing to pay when buying or the minimum price you will accept when selling a stock. Limit orders ensure better control over trade execution, helping investors avoid unfavorable price fluctuations. However, there is no guarantee that the trade will be completed if the market price does not meet the specified limit. This type of order is especially useful in volatile markets or when dealing with low liquidity stocks.
Market orders.
A straightforward order to buy or sell a stock at the best available market price. Market orders prioritize execution speed over price, ensuring trades are completed quickly. While this order type is ideal for highly liquid stocks, it can result in less favorable prices during high volatility. Investors using market orders should be mindful of potential price discrepancies, particularly in fast-moving or low-volume markets.
Stop-loss orders.
designed to minimize potential losses by automatically selling a stock when it reaches a predetermined price. For example, an investor can set a stop-loss order at 10% below the purchase price to limit downside risk. While useful for protecting profits or reducing losses, stop-loss orders may trigger during temporary price dips, forcing investors to sell prematurely. Careful placement of stop-loss levels is essential for effective use.
Good till cancelled orders.
A type of order that remains active until it is executed or explicitly cancelled by the investor. GTC orders are ideal for those who want their trades to remain valid beyond a single trading session. However, these orders carry the risk of being executed during unfavorable market conditions if not monitored regularly. Investors often use GTC orders to set long-term target prices for buying or selling. Averaging down. An investment strategy where an investor buys additional shares of a stock after its price has dropped, reducing the average purchase cost per share. This approach assumes the stock's value will recover over time, allowing for greater profits when prices rebound. While averaging down can lower costs, it also increases exposure to a potentially underperforming stock, making it risky if the price continues to decline. If you enjoyed our video, please don't forget to like this video and share it with others. Also, if you want to stay updated with our upcoming videos, subscribe to our channel.